Hello, I hope you're doing well. My name is Jacqueline Vino from Galasso Learning Solutions, and welcome to this Nano recording. Today, we are going to discuss the last ASU that was issued by the FASB in 2025 as a little holiday gift to us all, which is ASU 2025-12. This ASU really covers a lot of different things, really getting into a very broad range of categories. We have a lot of information to get through during today's Nano course, so with that being said, let's go ahead and get started. The formal name of this ASU is ASU 2025-12, Codification Improvements, and this was issued in mid-December 2025 by the FASB. Now, why did they decide to issue this ASU? This is actually part of the FASB Standing Technical Agenda project to address various suggestions received from stakeholders on the FASB's codification and to make other incremental improvements to GAAP as well. The resulting amendments are collectively referred to as the Codification Improvements. Really, the goal here is to not make major overhauls to how we do accounting or our disclosure requirements or anything like that. Really, what they're trying to do is just enhance clarity, correct some errors that were maybe in some examples, generally improve the application of the GAAP, trying to make financial reporting a bit more straightforward for a very wide range of entities. So who is within scope of this ASU and what is sort of the impact here? Well, it doesn't specifically apply to just nonprofits or just private companies or public companies, for instance. Since it covers such a very wide variety of topics, it's going to impact all reporting entities that are within scope of the amended guidance. So in essence, it impacts everyone in different ways. But I do want to mention right off the bat, it's not intended to have really a gigantic impact on anyone's accounting. Once again, these are just, corrections of errors and updates and just things to enhance clarity a little bit more. So, what are the updates within ASU 2025-12? Well, we have 33 different issues that are addressed, and don't worry, we're going to review them all over the next 2 slides and just sort of talk about them at a high level so we all feel prepared for the changes. So in this section, as I mentioned, we're going to first walk through issues 1 through 16 of ASU 2025-12. And these issues are, once again, mainly just to clarify existing GAAP, fix minor errors, and just sort of clean up the terminology and cross-references rather than create new accounting models or anything super complex like that. So let's see what we have here. Item 1 removes the obsolete master glossary term amortized cost in favor of the existing defined term of amortized cost basis. So there are no duplicate definitions and there is overall no change in accounting, just removing a basic glossary term here. Issue number 2 simplifies the description of comparative financial statements by referring more broadly to them as financial statements, as opposed to listing specific items like the income statement or the balance sheet. That doesn't apply to all types of entities. So this guidance works a little bit better for different types of organizations and the required statements. So again, broadening that term. Issue 3 corrects a label and a mathematical error that was in an illustrative statement of comprehensive income. So the example has just been corrected. So now it has the appropriate numbers and it also matches the narrative more appropriately. Issue 4 clarifies that diluted earnings per share when there is a loss from continuing operations and certain contracts that may be settled in stock or cash. Entities consider both the numerator adjustment and the extra shares and include them if, together, they are dilutive. So dilutive EPS will usually, but not always, be equal to basic EPS in a loss period. Issue 5 clarifies disclosure expectations for lease receivables from sales type and direct financing leases. So those receivables are treated consistently with other credit exposure disclosures. Once again, just, clarifying the requirements there. Issue 6 refines how to determine the reference amount for certain beneficial interests, promoting consistent application in structured finance and credit loss calculations without changing the measurement objective. Issue 7 is going to formally link affected paragraphs to the existing glossary term, class of financing receivables, reinforcing that related policy elections, like how to present or write off accrued interest, are made at that class level. Issue number 8 is going to remove a superseded paragraph in the property, plant, and equipment guidance that has already been overtaken by later revenue and non-financial asset derecognition guidance. So once again, just improving that and removing out those old paragraphs. Issue number 9 corrects a cross-reference in environmental obligation guidance. So it points only to the specific paragraphs that address when capitalization of environmental remediation costs may be appropriate. All right, guys, almost halfway through this one. Issue 10 here is going to clarify acceptable methods for handling the excess of repurchase price over par or stated value in treasury stock retirements. It also confirms that excess may be charged to retained earnings, allocated between additional paid-in capital or retained earnings, or in some cases, charged entirely to additional paid-in capital, so long as additional paid-in capital is not driven below zero. Item 11 here fixes a misstated date in a repurchase agreement example in the revenue guidance, so the option lapse date lines up with the rest of the fact pattern. Issue 12 aligns intra-period tax allocation wording, so tax expense or benefit is consistently allocated to continuing operations, other comprehensive income, and other components in line with where the related pre-tax items are reported. Item 13 removes a stray reference to the pooling of interests method, reinforcing that business combinations are accounted for under the acquisition method. Issue 14 updates references in the investments guidance, so they now point to the current equity securities method, reflecting the move away from the older cost method and AFS structures. Issue 15 updates a reference for non-for-profit financial statement presentation, so it directs users to the current nonprofit presentation topic and supports consistent display and classification. And then last but certainly not least on this slide, we have issue number 16, which adds a reference to the other than temporary impairment framework in the context of equity method investments, helping entities find the appropriate impairment concepts without creating a new model. So once again, just making things a little bit easier there. Excellent. So now that we've covered issues number 1 through 16, we'll move on and cover the remaining items here, which are 17 through 33. This really continues with that theme of trying to clean things up, trying to make further clarification. However, what we're going to talk about here has a bit more of an emphasis on nonprofit organizations, specified industries, and a lot of updated illustrations. So we'll see this theme kind of throughout the remaining topics. So taking it right from the top here, we have issue number 17. This updates the illustrative statement of cash flows for an entity in reorganization, so it aligns with current presentation requirements. We have issue 18. This refreshes the fresh start reporting example to be consistent with today's guidance on reorganization, fair value, and goodwill. We have item number 19 here, which removes a remaining reference to the no longer used cost method for investments, reinforcing the use of current fair value and equity method models. Issue 20 clarifies how guidance applies when receivables from contracts with customers are transferred, helping to align revenue and transfer servicing guidance in those transactions. We have issue 21, which fixes a sentence fragment in transfers and servicing implementation guidance, making the instructions more clear and less open to interpretation, right? So we have a better idea of what to expect there. Issue 22 removes the obsolete OTTI impairment guidance that has been superseded by newer financial instruments and credit loss models. Issue 23 clarifies when non-for-profits should use nonprofit-specific consolidation guidance versus the broader consolidation model, making that hierarchy a little more explicit. Issue 24 removes the phrase recognized and unrecognized from nonprofit and healthcare income statement guidance to avoid implying that unrecognized items belong on the face of the statement. We have issue 25. It clarifies how nonprofits should account for certain receivables, such as contributions receivable and promises to give, by better connecting contribution, revenue, and credit loss guidance, just making things a bit more clear and easier to understand. We have issue number 26, which clarifies impairment guidance for institutions of higher education, right? So thinking about the education field here, helping them evaluate specialized long-lived assets and related investments more consistently. We have issue 27, which removes an outdated reference to equity securities from nonprofits' other investment guidance. So equity holdings clearly fall under the current equity securities model. We have item 28 here, which removes a reference to using probability assessments in deciding whether part of a transaction is a contribution, aligning practice with the current focus on commensurate value rather than probability. Issue 29 updates nonprofit business combination guidance to explicitly reference the usual expectations to the recognition principle, which is going to bring nonprofit contributions in line with the broader acquisition framework. All right, we got our last 4 items here. We have issue 30, which clarifies which acquisition and combination guidance a nonprofit acquirer should follow, pointing it to the correct mix of general and nonprofit specific requirements. We have issue 31, which adds a cross-reference to hedge effectiveness guidance relevant to nonprofits that use derivatives and hedge accounting. We have issue 32, which updates a defined contribution plan example, so it reflects the current practice for presenting contributions, benefits, and administrative costs. And then last but certainly not least, issue number 33 updates real estate guidance to reference the proportional amortization method for certain tax credit-driven real estate investments, aligning with newer tax credit investment guidance, right? So as we can see here, very broad, lots and lots of different issues. Now, probably most importantly here, what is the impact of all of these changes? This is not intended to result in significant changes for most entities. Instead, these just represent changes to the codification that clarify, correct errors, and also just make minor improvements. Hopefully, this will make the codification easier to understand and apply. However, the FASB recognizes that changes to the guidance may potentially result in accounting changes for some entities, but not everybody, right? So when is the effective date of ASU 2025-12? This is effective for all entities for annual reporting periods beginning after December 15th of 2026 and interim reporting periods within those annual periods. Also, an entity may elect the transition method on an issue-by-issue basis, right? We've got 33 different issues, so we're going to take that on a case-by-case scenario. An entity should also apply the changes except for issue 4, which is once again the earnings per share items there, using various transition methods. We could do prospectively, or we could do a retrospective approach as well, except for issue number 4. That should be applied retrospectively to each prior reporting period presented in the period of adoption. And that is all we have for today, folks. If staying up to date with the FASB is part of your job, consider taking our FASB update course that has all of the recently issued ASUs from the FASB. Additionally, if you are interested in taking CPE from GLS, we've included another QR code for you here. We have lots of different courses in accounting, auditing, government, and nonprofit A&A. So if you need your Yellow Book requirements to be met, as well as professional development and audit staff training courses. In addition to our live courses, we also have webinars, and we also are on LC Vista. It's our on-demand platform. Once again, my name is Jacqueline Vino from Golasso Learning Solutions, and thank you so much for tuning in to today's Nano course. Hopefully you have a wonderful rest of your day.